Nothing is certain but death and taxes. This expression, given by Benjamin Franklin, is synonymous with certainty in this constantly changing world. This quote is true till now. The origin of taxes is traced in 6000 BC from the clay tablets found in the ancient city state of Lagash in modern Iraq. During those days, the rulers collected minimum taxes except at the time of hard times such as wars and other calamities. The first known system of taxes comes from the first dynasty of ancient Egypt around 3000 to 2800 BC. The first income tax is generally attributed to Egypt, where the pharaohs collected taxes from their citizens to fund grain warehouses, building projects, including the pyramids and local armies. The Greeks, Egyptians, and Romans too imposed taxes for raising money in order to utilize it for centralized government activities. Even now, many developed countries are following the different types of taxes levied by the Greeks in earlier days. An example for this is taxes on property and goods. The spread of Greek civilization in Europe, North America, and Middle East in the centuries led to the continuous development of tax practice in those countries as well as the emergence of the Common Era. In 1799, the Rosetta Stone clay tablet was identified, and it is an evidence for the new tax laws decreed by the Ptolemaic dynasty in 196 BC. Proper census record was used by the Chinese Tang and Song dynasties to have an accurate count of the population and imposing taxes based on it. The collected tax amount was used by them to support armies and to construct canals and other projects. Around 1200 AD, Asia was under the control of Mughal Empire, and they constituted the tax policy to collect taxes from the large scale production of certain goods like cotton. In 1798, Britain imposed income tax on personal wealth tax in order to meet the losses due to the wars with Napoleon. Later, it was revoked in 1815 after the Battle of Waterloo. In 1841, Sir Robert Peel imposed it again and it continued. The word tax first appeared in the English language only in the 14th century. It derives from the Latin word taxare, which means to access. As we have seen earlier, many taxes, particularly the income tax, was first introduced in Great Britain in 1798. Tax, in simple terms, is the money that one has to pay to the government so that it can provide public services. The system of taxation has been in existence about 2300 years ago. The present system of taxation in India is based on the ancient tax system, which can be traced back to Manusmriti, the ancient book of laws penned by the sage Manu, and Arthasastra, Kaudilya's famous treatise on economics. During the Sultanate period, the Sultans of Delhi introduced Jagirdar system. The same system was followed by Mughals, Rajputs, Sainis, Sikhs, and even by British. In the Mughal period, Akbar introduced Japti system in 1580. The Maratha king Chhatrapati Shivaji abolished Jagirdari Jamindari system and introduced Chauth tax. The kings who ruled our countries way back collected taxes in order to do good for the people. The kings collected taxes in such a way that do not feel the pinch of paying taxes. Sir James Wilson, who was the finance minister during the British rule, introduced the income tax in India in 1860 for meeting the laws of the Sepoy Mutiny in 1857. In 1886, license tax was converted into IT Act. In 1916, graduated rates of taxation on income above 2000 was introduced. Super tax was introduced in 1917. New IT Act of 1918 was passed in the year 1918. In 1919, Act of imposing duty on excess profits included. Later, in 1920, it was abolished. Indian Income Tax Act of 1922 was passed in the year 1922. Between 1939 and 1956, the Income Tax Act of 1922 was amended 29 times. Capital gains tax was introduced in 1946. Wealth Tax Act and Expenditure Tax Act were enacted in 1957 and Gift Tax Act in 1958. In consultation with the Ministry of Law, the present Income Tax Act 1961 was passed in 1961 and came into force from 1st April 1962 onwards. It applies to the whole of India and Sikkim including Jammu and Kashmir. Every year, the amendments in the Act are made based on the finance bill which is presented at the time of Union Budget. The present tax system also focuses on the theory of maximum social welfare. Taxes in India are levied by the central government and state government. Example, income tax GST is levied by the central government, whereas stamp duty and property tax is levied by the state government. Few minor taxes are taxed by the local authorities like municipalities too. Taxes are the largest source of income for the government. Tax payment is not optional. It is mandatory for the citizens of India to pay relevant taxes. Hope you enjoyed learning the development of taxation in India. Now we will be learning about the structure of tax in India, types of taxes, and heads of income. First, we will see types of taxes. Broadly, there are two categories of taxes in India, namely direct taxes and indirect taxes. Direct tax is paid by taxpayers directly to the government. It is levied on the income of individual and corporates. It cannot be transferred to others. Example, income tax. The second type is indirect tax. Indirect tax is paid by the taxpayers through others. It is collected by intermediaries who are selling goods and services, and they pay to the government on behalf of the taxpayer. Example, GST. The other types of indirect taxes are excise duty, customs duty, etc. Other types of direct taxes are gift tax as well as wealth tax. Again, direct taxes can be further classified into income tax and corporate tax. Income tax is a tax levied on the income of individuals or a Hindu undivided family or any other taxpayer other than corporates. Now we will move on to the heads of income. At present, there are 5 heads of income, such as income from salary, income from house property, profits from business or profession, income from capital gains, income from other sources. Income from salary for the purpose of Income Tax Act 1961 will include both monetary payments such as basic salary, bonus, commission, allowances, etc., as well as non-monetary facilities such as housing accommodation, medical facility, interest-free loans, etc., less the allowable deductions under Section 16 with respect to salary. This head of income is applicable only to the individuals. Income from house property is one of the 5 heads of income under which income arising from a house property is liable to tax under the Income Tax Act 1961. As per the definition under the Act, a house property consists of any building or land appurtenant thereto which is owned by a taxpayer. Such a building may be used for commercial or as a residential purpose. However, this excludes a property which is used for the purpose of carrying out the taxpayer's business or profession, the profits of which are chargeable to income tax. Income earned by letting out of the house property less the allowable deduction under Section 24 will be taxed under this head. This head is applicable to all types of assessee. The term income from business or profession means any income shown in the profit and loss account after taking into account all the allowed expenditures by an assessee. The income also includes both positive, that is profit, and negative income, that is loss. In other words, profits and gains represent plus income while loss represents minus income. So both legal and illegal business incomes are taxable in nature. The income earned by the assessee from the previous year is taxable. Next comes income from capital gain. Income from capital gain includes any income derived from a capital asset, movable or immovable, is taxable under the head capital gains under Income Tax Act 1961. The capital gains have been divided into two parts under Income Tax Act 1961. One is short-term capital gain and the other is long-term capital gain. This head is also applicable to all types of assessee. The last head of income is income from other sources. Income from other sources, which is the last among the 5 heads of income sketched out in the Income Tax Act, is essentially a head of income that includes all receipts that cannot otherwise be classified under any of the other heads of income. So, dear students, having understood broadly about taxation, its classification, and about history of income tax,